Welcome to the Early Retirement Roadmap Podcast, the show all about achieving and thriving in early retirement. Today we're going to talk about something that a lot of early retirees worry about, healthcare. More specifically, how your income strategy in retirement can dramatically affect how much you pay for health insurance through the Affordable Care Act, also known as the ACA or the Marketplace. 3 weeks ago, I published a YouTube video and podcast that really took off. In it, I explained how early retirees can qualify for generous ACA subsidies by strategically managing their income, and how a taxable brokerage account can be a superstar in making that happen by reducing your modified adjusted gross income or MAGI. While the video prompted a great follow-up request from viewers, can you show some real-life income scenarios and walk through what the actual ACA premiums would be? So that's exactly what I'm doing in today's episode. I'll walk you through 3 early retirement scenarios, all based on real numbers I plugged into the Healthcare.gov estimator. Now, obviously, this topic is a little visual, so if you want to see the on-screen demo where I use the actual ACA estimator tool and show how being strategic about how you fund your retirement income makes a huge difference in health insurance costs, check out the YouTube version. I'll link it in the show notes. But don't worry, you can still follow along here as well, where I'll talk about the scenarios and the results I received with the ACA estimator tool, and hopefully motivate you to use it as well and run it for yourself. Before we get into the thick of it, let's define a few things for those that have not seen my previous video or podcast, or are just not familiar with these terms. First, your modified adjusted gross income or MAGI is what the ACA uses to determine whether you qualify for subsidies. It includes most forms of income like IRA and 401k withdrawals, capital gains, dividends, and even Social Security. But it does not include withdrawals from a Roth IRA as long as they're qualified. That means the Roth account has been open at least 5 years and you're either over age 59 and a half or meet another qualified exception like permanent disability. But for most early retirees aiming to keep income off their tax return, what is easy to remember is the Roth has to be open for 5 years and you must be over 59 and a half to withdraw any earnings tax-free, as your contributions you can always withdraw tax-free. MAGI also doesn't include HSA spending or the return of your original after-tax contributions from a taxable brokerage account. So if you're strategic of how you're funding your early retirement, say pulling money from a taxable brokerage account and perhaps also funding your retirement with your Roth a bit, you can keep your MAGI lower and qualify for much more affordable health insurance. And I'm going to share those dramatic results with you in this episode that I found using the ACA estimator. Before we dig in, some notes about the scenarios. For the numbers I'm about to share, I use a Des Moines, Iowa zip code to keep consistency between the scenarios with the ACA estimator. Keep in mind, you'll want to use the ACA website's estimator yourself and input your zip code as the premiums and plans vary by location. But the examples I use in this video give you a good idea of what you might expect when you run the estimator for yourself and see the huge difference a solid retirement income strategy makes to reduce your MAGI and how it can dramatically reduce your health insurance costs. Here's our first scenario. Sarah is single and planning to retire this year at 56. Her strategy is to live off dividends and withdrawals from her taxable brokerage account. Her estimated MAGI is around $22,000. When I entered that into the ACA estimator, the system calculated a premium subsidy of $749 per month. That brought the cost of her silver plan premium to basically zero, and the deductible dropped all the way down to zero as well. That's incredible. And she has an out-of-pocket max of only $1,850 on the first silver plan I saw. Why so generous? It's because of the additional cost-sharing reductions you can receive for silver plans When your income falls between 100 and 250% of the federal poverty level for your household size, which Sarah's does and why she is getting these. And those cost sharing reductions are only available on the silver plans. Now, let's say Sarah wasn't being strategic. Instead of using her brokerage account, she withdraws everything from her 401k and ends up with a MAGI of $55,000. Since she will only be 56 when she retires, she'd usually face a 10% early withdrawal penalty for withdrawing from her 401k before age 59 and a half. But there's an exception known as the rule of 55. That rule says if you leave your job in the year you turn 55 or later, you can withdraw money from your employer's 401k without penalty. You still will have to pay ordinary income tax on the full amount you withdraw, of course. But here's the catch. That higher income drops her premium subsidy to $399 per month and made her premium go from $0 to $347 per month and eliminates those cost-sharing reductions. Her deductible jumped up to $5,500 from $0 and her out-of-pocket max from $1,800 to $8,600. That's a pretty dramatic difference and illustrates how being strategic about your retirement income funding makes a huge difference. My second scenario is Brad and Maria. Both are 60 and married. Their MAGI, they're estimating to be $38,000, and they're going to fund their retirement strategically from their taxable brokerage account. With that income, their monthly ACA subsidy comes out to a whopping $1,696. Their bronze plan premium drops to $0, and they get extra savings on silver plans thanks to those cost-sharing reductions. Their silver plan premium is $39 per month with a $1,200 deductible and a $6,000 out-of-pocket max. But when I changed their MAGI to $80,000, replicating them funding their retirement entirely from their 401k, the subsidy dropped to $1,189 instead of $1,696. That's still something, but now they're over the 250% federal poverty level mark and lose those cost-sharing reductions. So on the silver plan, instead of the premium being $39 per month, it's now $546 per month, and the deductible is now $11,000 instead of $1,200, and the out-of-pocket max is now $17,200 instead of $6,000. So again, very dramatic differences. The third scenario is Tom and Elaine. Tom is 56, Elaine is 61, and they have a daughter age 20. Who will also need to be on their insurance with the ACA. In this scenario, they're expecting their MAGI to be $50,000, funded mainly from selling appreciated shares in their brokerage account. Their monthly subsidy comes out to $1,888, and their silver plan premium is just $65 a month with a deductible of $1,200 and an out-of-pocket max of $6,000. If they instead pulled $100,000 to fund their retirement income entirely from Elaine's 401k, that jumps their MAGI up quite a bit, and their subsidy drops to $1,279 from $1,888. Their silver plan premium shoots up to $674 per month instead of $65, with a deductible of $11,000 instead of $1,200 and an out-of-pocket max of $17,200 instead of $6,000. Again, all because they went over that 250% of the federal poverty level threshold and lost their cost-sharing reductions. So what do we learn from these scenarios? Strategically managing how you fund early retirement can save you thousands of dollars in health insurance premiums and costs each year. And under the current ACA rules, thanks to the Inflation Reduction Act that will be in place through 2025, there's no fixed income cap for receiving subsidies. Instead, subsidies are designed to ensure that the cost of the benchmark silver plan doesn't exceed 8.5% of your household income. So even if your income is above 400% of the federal poverty level, you might still qualify for a subsidy, especially if you're older or live in an area with higher insurance premiums. Whether or not these expanded ACA subsidies continue past 2025 will depend on what Congress decides. The current rules came from legislation passed by Congress and signed into law. And while President Trump can influence that process, it's ultimately Congress that has to vote to extend or change these rules. However, even if the current subsidy rules are not extended past 2025 and we go back to the old system where if your income is over 400% of the federal poverty level and you get no subsidy at all, that's even more of a reason to keep your MAGI low in early retirement. Because if you're withdrawing strategically and keeping your MAGI low, you're probably going to fall under that 400% FPL line anyway and still get subsidies. So whether the generous rules continue or not, the core strategy stays the same. Keep your taxable income low and health insurance stays much more affordable. Now, as I mentioned in my previous video and podcast that this is the follow-up for, while the lower your MAGI you have in early retirement, the larger your subsidy will be, and you could qualify as well for the cost-sharing reductions I just talked about. You have to be careful about going too low, especially if you're in a non-Medicaid expansion state like Texas, Florida, Georgia, or South Carolina, and your reported income is below the poverty line. You could fall into what's called the coverage gap, where your income is too low for ACA subsidies, but you also don't qualify for Medicaid under your state's stricter rules. So you could end up with no affordable health insurance at all. If you live in a Medicaid expansion state, you'd be shifted into Medicaid instead of an ACA plan, which is low or no cost. I hope this episode helped you better understand how ACA subsidies work and why managing your MAGI is so important in early retirement to keep your health insurance costs low. Again, if you want to visually see this information and the actual demos I give using the actual online ACA estimator, check out the full video version on YouTube. Again, the link is in the show notes. And as always, if you found this helpful, please subscribe or follow, leave a review or comment, and share it with someone who might benefit. Until next time, I'm Mike Upland, and this has been the Early Retirement Roadmap Podcast. Take care and make the most of today.